Well, commodity prices are enjoying their best run in years. Is this fresh evidence that investors are betting on a pickup in the global economy after years of sluggish growth and scant inflation? But most importantly, what are the drivers of this resurgence? And of course, is it sustainable? This is the MoneyMakers. I'm Bruce Whitfield. I'm joined hopefully this evening by Peter Major. He's with Cadiz Corporate Solutions. But for the meantime, let's chat to Bevan Jones, Chief Executive of Thebe Ventures, to discuss whether or not this is the rally or the dead cat bounce. I didn't hear a meow, so I'm assuming it's a rally.
Yeah, I think there has been a bit of a rally, but I think for South African producers, they're probably feeling it a bit tougher with the strength of the rand recently.
It's ironic, isn't it? I mean, if it doesn't, the rand doesn't bite you in the backside on the way down, it'll bite you on the way back up again.
No, for sure. But I think you also have to differentiate a rally in what, you know. I mean, if I was to sort of look more long term, I would say certainly copper is you know, there's room for that. And gold possibly. We can talk about that. Iron ore strangely has been good, but iron ore is such a speculative market. I mean, your average Chinese investor just loves to bet on iron ore on the Dalian exchange, and there isn't really a long-term fundamental reason for it to continue rallying.
But there's nobody. Are stockpiles not building? Because one gets mixed reports about Chinese stockpiles are depleted. As a result, they need to replenish the stockpiles, and that's what's behind this surge in demand for iron ore. The price goes to $90 a ton. Kumba pays its tax bill, doesn't even sneeze, and carries on.
I think it's so difficult to trust the Chinese numbers and what is actually real and what's not. But I mean, I think certainly you saw a lot of iron ore production coming off from Australia. But I think, you know, that's quite quickly can be turned back on, and Kumba can quite quickly turn back on a lot of production and shifts that they let go. So, you know, the market is quite quick to respond these days, especially with open cast mining, where it's easy just to put in more trucks or something. But yeah, I think the rallies are probably starting to have felt, and maybe we saw a bit of a Trump effect. But I think that is those sorts of things are coming to an end now.
There's some fairly clear indications, though, that the US is inclined to raise interest rates, which implies that they feel comfortable about the inflationary picture in the United States. But a dollar devaluation helps with pushing American inflation up a little bit, and hopefully they can contain it. We're seeing a little bit of inflation come into Japan, a little bit of inflation come into Europe. Those are indications of demand or not?
Yeah, I think, well, yeah, you would think so. And I mean, maybe commodity prices are chasing what they think are higher in inflation. You're never really sure if commodity prices come first and then inflation follows, or if it's the other way around. But I think certainly we've seen the industrial heartland of the States be or look to be revitalized, and there you would see steel demand increasing, and hence iron ore would flow into that. But not so much coal. You know, coal is the whole America first thing, and there's plenty of coal in the States, which needs a home. So I don't think coal producers are going to do that well. And you're seeing coal prices come off a little bit compared to, say, iron ore. Oil prices as well are typically, you know, the global barometer.
Well, it was so interesting because oil prices were very happy in a band of $40 to $45. Occasionally would break out of that. Suddenly OPEC decided to do a quarter turn on one of the taps, and we saw a bit of a recovery in the oil price, pulled back down again, and only when it got the non-OPEC members to agree also to cut back a little bit in December did we see it sort of sustain around $55.
A bit of a rally, but it didn't really rally that much. I mean, it's been trading in a band of, say, $2 to $3
this time
for the
last
last
year,
few
South Africa
weeks.
sold off its strategic reserves at $29 a barrel.
Yeah, but
and we're trading it twice that.
I would like to think that when we sold the oil, we bought petrol and diesel. So the strategic fuel fund became instead of an oil storage, they've become a product storage, but now you have to trade those products because you can't store petrol and diesel long term like you can store oil. So yeah, I wonder about oil, and I'm inclined to think that we're about to see a bit more of a push down before we see anything up, much to OPEC's disgust, I'm sure. But you've never seen more net speculative length on the oil exchanges as you have now. As in the number.
What does that tell you? What does that mean?
It means the speculators are normally wrong.
Yeah.
You know, they're all piling in on the downside, and what will happen is if fundamentally There is more oil out there, and US storage is full, and it's everywhere. It's full, and if fundamentally oil prices start coming off and start to force the oil price down, all these speculative investors, much like you see in iron ore, will head for the exits.
Once they head for the exits on oil, do they head for the exits on everything else? Because once your faith is shaken in one particular commodity,
well, they probably head to gold. You know, there's this whole oil gold thing. You know, in oil, out of gold, and the sort of thing. So, and I think as that sort of fear of things maybe coming off, then people will just, like sheep, will go to gold because it's supposedly a safe haven.
And gold's been massively volatile. I mean, since the Trump election, we've seen gold rally as high as 1250, I think, is probably the peak.
Yeah, I think you have to look at a monthly chart on gold these days, and really just have that long-term view. I think having a couple of Krugerrand coins in your bedside table is probably a good idea long term, but it's not going to make you any money in the short term.
No,
unlike oil, which is like a daily trade that you can trade in and out of. Yeah.
I mean, from a producer point of view, I mean, Sasol, for example, which is still betting big on Lake Charles in Louisiana, it's got some big blocks off Mozambique, which we've been quite aggressive in exploring. I mean, it's still in the exploration game. These guys aren't sort of sitting on their hands.
Yeah, I think they have to. I think the way these big companies are valued is on their reserve ratio. So they have to keep investing billions of dollars in new exploration, in reserves, and you know, if they don't keep those reserves up, they run out of life, effectively, like a life of a mine, life of a field. It is difficult to do business off of Africa, though, and I think a lot of people have been frightened away from just the sheer cost of the facilitation.
I was chatting to one of the chief executives of Sasol last week, who was just saying, well, we're not going to explore in South Africa. We've got a couple of blocks off Durban, but until we get the certainty on the MPRDA, the Mineral Resources Petroleum Development Act, we are not going to act.
I think this is the big problem for South Africa, is that the companies are not investing in Southern Africa, and they're not investing in replacing their reserves, which is all fine and well now to save some cash now, but in 5 to 10 years' time, we're not going to have a mining industry left or a resources industry left, because there's not going to be anything to mine. So it's a bit short-sighted, but unfortunately there's a cash crunch, I guess.
Peter Major has joined us. I'm delighted. Peter Major, Director of Mining at Cadiz Corporate Solutions. Got Bevan Jones in the studio, who it doesn't want to celebrate the rally we've seen in many of the core commodities that South Africa produces. Are you more of an optimist or a pessimist in terms of the rally that we've seen for the last couple of months on some of our core commodities?
No, I'm afraid I'm a pessimist, Bruce. And you called this thing 100% right just over a year ago when I was on your program. I think it was the first week of December 2015. You said, Pete, I see there's some fund managers who are starting to nibble. And I said, well, they better nibble small. There's more to come. You were dead right on gold. You were dead right on the rand. And you were dead right on coal. The other commodities took about another month or two, but that was a magnificent rally coupled with the weak rand. And it went until about July. But really, since about July, we've pretty much been oscillating, Bruce, in the same range now for 9 months. And I think a lot of it's being held up by the Trump factor. A lot of it was being held up by China giving it one more shot. But I think both of those cannot hold up these commodity prices much longer.
Okay, so commodity prices then, are they in bubble territory? Is that the risk here?
Some of them are, yeah. Iron ore at $90 is definitely bubble territory. Coal at $85, definitely bubble. In fact, most of these commodities are trading above their long-term averages. And to trade above an average, you know, it's like going against gravity. You can do it, but you need constant propulsion to do it. So you have to ask yourself, what is the constant propulsion pushing these commodities above their long-term means? And is it artificial growth? Is it stimulatory growth? It's sure not lack of supply, and it's not excess demand. I think that's our problem here. We got too much supply. Everybody is making money at today's commodity prices, and there's not enough demand to take that up.
So how do investors behave, Peter Major, in this sort of environment where you don't want to miss out on the ride, you don't want to miss out on the momentum that's carrying this thing forward, but you certainly don't want to be kept holding the baby when it all goes pear-shaped?
Bruce, I would never give my money to somebody who is afraid of missing out, especially after something's run. You know, does Warren Buffett ever act like he's afraid of missing out? And Buffett is the first guy to tell you, after every consideration of an investment, the main important one is still the price you pay. It's not global growth. It's not inflation. It's not your currency, depressed earnings. It's what you pay. And so anybody who says, oh, I'm afraid of missing out, I know they've run 100, 200, 300%, but I'm still afraid of missing out. I'll almost guarantee you that guy's going to lose you money. If you're afraid of missing out, where were you a year ago when Bruce Whitfield said, hey, this looks really close to the bottom. This is a capitulation type territory. That's when guys who didn't want to miss out should have been getting in. Not after most of these commodity shares have put on a few 100%.
Peter Major, Director of Mining at Cadiz Corporate Solutions, thank you. He remembers better than I do, and I don't think I've ever used those kinds of words because I would never have the confidence to do it. Maybe it was the tone of the question which you interpreted, Bevan Jones. So I'm the guru now, still as poor as I was 12 months ago, so that piece of insight was completely worthless.
Indeed.
But FOMO is the critical point here. When you've got people who they've missed out on a huge rally in markets and they think that they really need to capture at least some of it before the bubble pops.
But what investors are we talking about here? I mean, the guy who invests in a mining company shouldn't be chasing the daily gold price movement. He should be investing for fundamentals.
Yeah, but, sorry, you're talking about gold and investing for fundamentals. So that's contradictory.
But I think if you're talking about traders who are trading the futures market every day, then sure, there's trading bands that get established, and you buy low, and you're battling against the computers and it's actually become a lot less volatile, especially in like the oil market, for instance. We used to trade at 30% volatility. We're probably sitting around 15% volatility at the moment. I just think because of the number of traders that have come into the market, the number of speculators, and speculators are good. They help to even out the price, but you lose a grip of the fundamentals. So
and is that precisely what causes these bubbles?
It's what causes things to revert back to their real price. When the speculative froth just gets too much, then eventually things will revert back to their real price.
At what point is speculative froth?
Well, I think
frothy, and what point is it too much?
Well, I mean, you've got to look at the history of commodities, and you got. I suppose you have to apply a long-term inflation, and you would hope that commodity prices over the long term would keep pace with that. For coal now, we started the coal market in 2005. We've got over 10 years now of trading history. So we've seen the lows, we've seen the highs, and we're trading somewhere in the middle of that. Similar to iron ore, we're trading kind of in the middle, which is kind of what you'd expect people to do. They've tested the highs, which were crazy days, and now we're back to like that 50% retracement. And I think that's kind of where we'll stick now, because now most people have sort of learned about this, and they don't want to make the same mistake. So we're going to be much more cautious going forward. At the same time, the big trend that's happening is there's less exploration going in copper, gold, certainly platinum. So I think those three commodities long term you have to be fundamentally bullish on, because also there is demand for those. Gold, not so sure why the demand is there, but it's there, and for copper certainly, and for platinum. Yes. Other things, iron ore, there's too much of a scrap market in China that's developing. There's too much supply. Coal, people are shutting down coal power plants. So without the actual coal power plants and all the IPPs that are now coming in and renewables replacing it, that whole sector is undergoing a complete reworking of itself. But it doesn't really bode well for coal,
No, but some interesting views this evening. Thank you very much, Bevan Jones, Chief Executive of Thebe Ventures, and also to Mr. Cadiz, to Peter Major. Thank you very much for joining us briefly this evening as well, and for your magnificent recollections of my superior insights, which I'd already forgotten about. More peaks and troughs in the commodity cycle and how to ride them next time on the MoneyMakers. Till then, bye-bye.